In this week's video, we'll review the latest charts to help us answer the question, is the Dow waving bearish flags? If we compare the performance of the S&P 500 to the Dow Jones Industrial Average, year-to-date, as of the close on July 12, 2018, we can make the statement the Dow is lagging the S&P 500 by 3.8%. The shoe was on the other foot on May 16, 2017. In this case, we could have made the statement, for the period shown, the S&P 500 is lagging the Dow by 3.4%. Should we be concerned when Index A lags Index B? The answer is no. It happens all the time. There are times in the market where all three major indices make a high at the same time, and we'll see headlines that tell us that's bearish. And then we have periods, similar to the present day, where the Nasdaq makes a new high, and the S&P 500 and the Dow have yet to confirm it, and that gets construed as bearish. Even if we felt that this was a reliable and back-testable metric, it's still only one data point relative to the weight of the evidence. So let's assume on May 16, 2017, we said we do not want to commit any new capital because the S&P 500 is not confirming the move in the Dow because it's lagging. Would that have been helpful in this anecdotal example? And to answer that question, we'll ask another one. From this point here, where the S&P 500 was clearly lagging the Dow, what happened in the stock market over the next year? The answer is, rather than this divergence being some type of bearish non-confirmation, the S&P 500 from this point here over the next year tacked on an additional 15.5%. Many of you may remember, relative to fears regarding a potential trade war, the first real significant impact of the term tariff came on Thursday, March 1st, 2018. What can we learn if we ask the following questions? How have the U.S. markets performed since March 1st, 2018, when this headline here appeared in the New York Times? Question number 2. Does the market think China will come out ahead? Like everything we do in these videos, we won't answer these questions with hypotheticals or opinions about what may or may not happen in the future. We'll answer the questions with hard data and present-day facts. Since March 1st, 2018, the triple Qs, or the NASDAQ 100, are up 9.52%. Has the S&P 500 or SPY plummeted since the term tariff arrived on March 1st, 2018? The answer is no. SPY is up 5.25% between March 1st, 2018 and the close on Thursday, July 12th, 2018. Conversely, over the exact same period, two major China ETFs, FXI down 7.98% over the same period, MCHI down 5.78%. On a relative basis, when this headline appeared on March 1st, 2018, if we were invested in the triple Qs rather than FXI, the United States-based ETF has outperformed the China ETF by 17.46% since this headline appeared on March 1st, 2018. To answer these two questions, no other commentary is necessary. Is it possible the fact that the Dow is lagging the S&P 500 by 3.8% year-to-date, is it possible that that is a bearish signal? The answer is yes, of course it's possible. However, if that's true, what has to happen? If this is a bearish non-confirmation, it basically says that at some point in the not-too-distant future, both the S&P 500 and the Dow will start to fall and move in the other direction. It should be noted they are both profitable year to date. Does the weight of the evidence support the theory that the Dow is going to continue to lag and, more importantly, move in this direction here? Thus, to help us better understand the potential that is a bearish non-confirmation in the Dow, we're going to return to some long-term charts that we've covered in past videos. It's important to emphasize once again, notice we are reviewing 100% facts, present day facts. We're going to move all the way from 1925 all the way to the present day in July 2018. There's no opinions here. There's no forecast. There's no fear of what might happen. We are simply assessing the facts that we have in front of us today. This is an annual chart of the Dow. You can see in 1925 on the left side here, we had a rally, and then we go into a period of consolidation into the 1940s, nearing 1950 near point A. At this point here, we can see, measure, and put in a model three things on this annual chart of the Dow. ADX black is starting to turn back up in a constructive way. CCI, or the Commodity Channel Index, crosses back above 100 here. And PPO, which is similar to MACD, gets a bullish cross. We can see this. Black was below red, and then we get the bullish cross with black moving above red. What happened next? The Dow Jones Industrial Average tacked on an additional 396% over the next 16 years. If we extend the annual Dow chart, now we're looking at 1925 all the way to 1985. Market fractals tell us that on all time frames, at some point, a market is going to need to consolidate its gains. That's exactly what happened here. And then we have a similar setup here in the mid-1990s. ADX starts to turn up. Black ADX starts to turn up. CCI recaptures 100. CCI recaptures 100. And PPO, bullish cross here, a very similar look here. You can make an argument, a sound argument, that this point A here is very, very similar to this point A here. We know that really good things happened after this point A for a long period of time. In the second instance, after point A, the Dow Jones Industrial Average rallied for an additional 14 years on the annual chart and tacked on an additional 658%. It's also helpful to compare and contrast the look of these indicators at a constructive bullish turn and the look at an unconstructive bearish turn, warning of potential longer-term consolidation or a bear market. Let's look at ADX, the bullish turn. Black is turning up from low levels. That doesn't look anything like this period here at point B, where good things came to an end. Black ADX is above both green and red, and it starts to roll over. We know this is the type of look that says you better pay attention. This trend is starting to wane. Instead of CCI moving from below 100 to above 100, CCI drops back below 100 here. This here doesn't look anything like this. In the bullish periods, black moves above red here, black above red here. Here, near point B, just the opposite. Waning momentum, we get the bearish black dropping below red. Very, very similar situation in the year 2000. This point B here looks very, very similar to this point B here. ADX is above both green and red. It starts to roll over, similar to this. Similar to this period here. CCI here is threatening to drop below 100, and we're about to get, potentially, a bearish cross. Remember, these are long-term confirmation signals. We wouldn't be using these time frames to time our positions or to alter our portfolio. We would be using similar concepts on faster time frames. Some of you may remember that we first reviewed these charts in November of 2017, and at the time, we asked the simple question: does the present day look more like the constructive periods or more like the concerning periods where the market was about to roll over? The answer is very, very simple. November 2017. Black ADX turning up, black ADX turning up, ADX starting to rise from lower levels. CCI recaptures 100, recaptures 100. We've recently recaptured 100 when we think in terms of an annual time frame. Bullish cross, bullish cross, bullish cross, which told us in November of 2017 that we should keep an open mind about much better than expected outcomes for a very long period of time. Which begs the question, if the theory that the fact that the Dow is lagging the S&P 500 year to date is a bearish non-confirmation, if that theory were to be supported by the weight of the evidence, we would expect to see deterioration on that chart of the Dow that looked very, very constructive in November of 2017. Therefore, if we fast forward to the present day, we would expect to see some type of morphing into the concerning looks that we just reviewed below the red arrows. Is that the case? The answer, from a factual perspective, it has nothing to do with opinions, is no. We still have a very, very constructive look. ADX rising black, ADX turning black. This is happening when green is above red. CCI above 100, CCI above 100, CCI still well above 100 on July 12, 2018. PPO bullish cross, PPO bullish cross, July 12, 2018, bullish cross. And as we noted in November, how early could we be in this cycle? The third signal came at the end of calendar year 2017, or basically 6 months ago. When we had all three signals in place here, the market rallied not for 6 months, but for 16 years. When we had all three signals in place here, the market did not rally for 6 months. It rallied for 14 years. And in this case, we have added the simple 8 and 9 yearly moving averages, and we still have a constructive look with blue clearly above red on July 12, 2018. And we've talked in past videos about the miracle of compounding. It's very, very difficult to wrap your head around the fact that it's possible for the stock market to go up nearly 400% over 16 years or up 658% over 14 years. But if you study historical charts, it's just the way markets work. Thus, in the present day, can we make an argument? Is it rational to try to make the argument that the Dow failing to push to new highs when the NASDAQ has pushed to new highs, or the fact that the Dow is lagging, should we potentially be concerned about that? The answer is yes, you can make a rational argument for that. However, the weight of the evidence, including the charts that we've covered in this week's video, and the charts that we covered in last week's video, do not support that hypothesis. Rather than focusing on one thing from a technical and fundamental perspective, we want to focus on the weight of the evidence. It's very, very rational to make the argument the longer a market goes sideways, the bigger the move we can expect to get. The longer a market goes sideways for a long period of time, breaks out of the consolidation box, and we get all three signals. And after we can see all of that, measure it, and put it in a model, good things happen for a long period of time. Everything that we just described at this point A here applies to the present day here. Sideways consolidation, a bullish breakout from the box, and all three constructive signals were in place at the end of last year, and they remain in place as of July 12th, 2017. Like every chart we cover in these videos, the chart, the moving averages, and the indicators help us determine the probability of good things happening in the future relative to the probability of bad things happening. The probability of bad things happening is never zero, which speaks to that flexible, unbiased, and open mind that we have to have heading into next week. Here's the little statistical nugget that we mentioned on our Twitter feed during the session on Friday, July 13th. MarketWatch article published July 13th at 1:56 p.m. Eastern Time. The stock market is a day away from setting a bearish record. The Dow and the S&P 500 could soon post their longest corrections since 1984. Here's the S&P 500, calendar year 1984. Here is where the closing high was made. Here's your correction, and here's your period of consolidation. As we move forward here, you'll probably agree this headline really should appear as follows. The stock market in 2018 is a day away from setting a consolidation record, because we know the longer a market goes sideways, this is the consolidation period. There was a correction, sideways movement, 1984. The market breaks out at point A here in 1985. The longer a market goes sideways, the bigger the move that we can expect to get. Rather than this period in 1984 being a bearish period, it was a normal and 100% to be expected correction within the context of an existing and ongoing uptrend. And if that's the case, what do bull markets do? They eventually go on to print higher highs. And that's exactly what happened in this case, because after the longest correction, which is really the longest period of consolidation, the S&P 500 tacked on an additional 785% from the breakout in 1985 to the peak in the year 2000. The article makes the point that this period of consolidation here is similar to the period of consolidation that we've experienced since the S&P 500 peaked on January 26th, 2018. There's another analysis that ties 1985 to the present day. It's the analysis that we've just covered previously in this week's video. This is 1985 here. We have the consolidation period, the bullish breakout, and ADX turning up, CCI giving us the bullish move above 100, PPO here with the bullish cross. This period that we just compared to the present day is the same period that's referenced in the MarketWatch article dated July 13th, 2018. The only difference between the two comparisons, this comparison here uses daily charts and this breakout point here, and this comparison also looks at basically the same breakout, but it does so using annual charts. So rather than this period being bearish as referenced in the headline, early 1985, which is here, this is 1985 where the breakout is, turned out to be extremely bullish with good things happening for a long period of time. We would consider the annual charts that we've covered in this video to be forest charts. Now let's move down to the tree level. S&P 500 weekly, as of the close on July 13th, 2018, the weekly chart just made a higher high above the orange consolidation box. This is your plunge in late January, early February 2018. Consolidation, what appears to be a bullish breakout. The longer the breakout holds, the more meaningful it becomes. It looks even better on the NASDAQ. This is the correction here earlier in the year. Not only have we moved above this consolidation box here, here's your bullish breakout that took place in the month of May, but now it appears that we've had a successful retest, and this week we went on to print a higher high above this weekly high. From a weight of the evidence and probability perspective, it's very, very difficult to say that this look here and this look here does not add to the bullish weight of the evidence. This chart also tells us that the odds favor this outcome. The odds favor the Dow closing the gap at some point between the S&P 500 and the Dow, and or the Dow pushing higher, rather than the theory that this Dow non-confirmation means both indices are about to roll over in a bearish manner. Of course, we don't know what's going to happen. We're simply assessing the probability of good things happening relative to the probability of bad things happening. Now we're looking at daily charts of the S&P 500 index, the year 2000 on the left side of the screen, 2007 where my cursor is on the right side of the screen. For this exercise, we'll be using the simple, generic, and for illustrative purposes only 150-day moving average all the way out to the 300-day moving average. If you know your market history, you know the S&P 500 peaked in March of 2000, but in September of 2000 it almost came back up and made a new high. So there wasn't much movement between September and March in terms of our highs. And at this point here, price drops below the moving averages and then price moves back into the moving average cluster. Here in early November of the year 2000, the market touched 1432 before dropping all the way to 768. So when we had this look here, when we could see this, measure it, and put it in a model after that, the S&P lost an additional 46%. Similar situation here. The market peaks in October. This is the look of the exact same moving averages in early December 2007. The S&P 500 made its way back to 1515 here, so this was the look of our moving averages. Thus, in the present day, we would prefer to avoid a look like this inside of this box here. We don't want to see the rollovers, and we don't want to see the tight cluster, and we don't want to see blue dropping from the top of our moving average cluster to the bottom. Blue. We don't want to see blue dropping from the top all the way down to the bottom as it is here. What we'd prefer to see is something like one of these two bullish scenarios. This is 1996. This is January 17th, 1996. This is the look of the exact same moving averages. From this point here, the S&P 500 tacked on an additional 156%. This is a more tame move here. 2013, September 27th. Here's the look of the exact same moving averages after this. After we could see it, measure it, and put it in a model, the market tacked on an additional 26%. A gain of 26% and a gain of 156% is quite a bit different than a loss of 46% and a loss of 56%. If you're in retirement or nearing retirement, these are the type of losses that are very, very difficult to recover from. From a market perspective, from a time perspective, from a miracle of compounding perspective, and maybe most importantly, from an emotional and sleep at night perspective. Therefore, it's prudent to ask, in the present day, do our moving averages look more like this concerning rollover look here, or this concerning rollover look here? Or do they look more like this constructive period here, and or this constructive period here? Here are the exact same moving averages as of the close on Thursday, July 12th, 2018. And keep in mind, on Friday, July 13th, the S&P 500, NASDAQ, and Dow were all green. So it's highly unlikely that this chart here changed very much on Friday. And remember, we're looking at the facts that we have in hand today. It has nothing to do with being fearful of what might happen in the future. This unequivocally looks more like this and this, relative to these ruin your retirement, I can't sleep at night looks like this and this. And like the other long-term charts that we looked at in this week's video, the look that we have here on July 12, 2018 tells us that the weight of the evidence unequivocally and unquestionably favors the bullish case here, and it doesn't align with the fact that this is a bearish non-confirmation that we have with the Dow relative to the S&P 500 on July 12, 2018. Those are simply probabilistic statements based on the facts that we have in hand today. It's absolutely positively possible that the low probability outcome is what we see in the next 6 to 9 months. But it's just that, a low probability outcome. The higher probability is that the S&P 500 and Dow eventually, between sometime now in July of 2018 and the end of the year, go on to join the NASDAQ and make higher highs. And last week we covered even more weight of the evidence charts, including asset class behavior. The present-day charts that we have in hand today favor bullish outcomes, a series of higher highs relative to bearish outcomes, or a series of lower lows. All of the charts that we covered last week should still be very, very relevant, because since we published this video, including the broad look at asset class behavior, over the past 5 trading sessions after this video was published, the S&P 500 gained 1.5%, the NASDAQ tacked on 1.79%, and the Dow was the leader at 2.3%. So it's highly unlikely that any of the charts that we covered a week ago have changed in a material way, meaning if you haven't seen this video, it's probably still worth a look. You can find it by Googling this title here. The present-day facts that we have in hand today tell us to keep an open mind about better-than-expected outcomes happening for a much longer period of time that we can wrap our minds around, and the gains from a compounding perspective are very, very difficult to contemplate when you're focusing on shorter time frames and shorter term outcomes. It's always prudent to remind ourselves that given what we know today, and that is subject to change, but given what we know today, our present day objective is to try to navigate between a point A and a point B that could be several years down the road. And the miracle of compounding tells us that something on the order of 952% over a 9-year period in one of the 3 major indices is well within reason from a historical perspective. Rather than focus on what's going to happen in the next 6 hours in the market, or the next 6 days, or even the next 6 weeks, the long-term charts that we've covered in this video, and even the daily charts that we've covered, tell us we should try to avoid these common missteps, which are basically having a very short-term focus and trying to avoid drawdowns and volatility. Remember, we covered this Nobel Prize winning research in the past. Myopic loss aversion is the combination of a greater sensitivity to losses than to gains, and a tendency to evaluate outcomes frequently. Evaluating outcomes frequently means you're worried about what's going to happen Monday morning, or you're worried about what's going to happen next week, which makes it very, very easy to forget the long-term potential that we have in front of us, given the facts that we have in hand as of July 2018. And the Nobel Prize winning research aligns very, very nicely with our list of common missteps that we frequently cover in these videos. The investors who got the most frequent feedback, and thus the most information, took the least amount of risk and earn the least money. And our flexible, unbiased, and open mind, that refers to the future. We don't know what this chart will look like in 3 days, 3 months, or 3 years. But that doesn't prevent us from confidently assessing the weight of the evidence that we have in hand today. There's nothing ambiguous about this chart here, and there's nothing ambiguous about the look of this chart here. Nor is there anything ambiguous about the weight of the evidence that we covered in last week's video. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.